Purchasing an investment property through a Delaware LLC offers significant asset protections and privacy, but it is subject to higher financing costs and strict compliance rules. So yesterday, I connected with an electrician who actually purchases investment properties through an LLC. In his particular situation, he has multiple properties, but one LLC. Through my research today, I learned that in order to help mitigate your tax liability per property, investors tend to create multiple LLCs or series of LLCs where they'll have an LLC per investment property. Now, when you do that, you'll have to consider your own financial situation and your own interest in what you're seeking to, obviously everyone is seeking to make a profit, but it does depend on what your current financials are and if you can do that. Because as you create multiple LLCs, you also create multiple tax bills. So you'll have a $300 finance tax bill due by June 1st every year for each LLC that you create. But depending on what the rent profit is, like what you're receiving in rent income and your mortgage payments and things of that nature that you will need to consider the actual bare bones and numbers, it may bode well for you to separate those things so that all of the money isn't getting funneled into one entity that's now going to get hit even harder because of that. You understand? So if you split it up and reduce that, then you actually can reduce the amount of tax that you'll have to pay with some respects. But it's worth looking into. In addition to that, what he also wanted to know was ways or things that he may be able to write off so that he could reduce his taxable income and, again, reduce that tax bill. Because it's an LLC, it's considered a pass-through tax. That means that it's going to pass through to your personal taxes. You're going to include it in your personal filing, like in your personal taxes, right? So in my research, I found when you're doing your taxes, you are able to write off much of what you spend in maintaining the property, acquiring the property, sustaining and the property. And when I say sustaining, for instance, lawn care. When I say maintaining, for instance, maintenance within the home where you've had to make significant repairs within the home. All of those things can be written off. In addition to that, in the state of Delaware, you can also write off your property tax payments. And you can also write off your mortgage interest payments on that investment property. Now, all these things can be written off on the Schedule C portion of your tax return. But what I also would like to add is that a major component of assuring that you're taking advantage of all of your write-offs throughout the year is implementing a process or system where you are maintaining documentation of all of your expenditures throughout the year. Now, that's not easy as it sounds, okay? But with implementing a system or a process to assure that that's happening throughout the year, then you won't even have to think about it because it will be going like this. Now, if you want to discuss doing something like that, customizing a process for you, go to my website and book a consultation, and we can talk about compliance processes that we can put in place to ensure that you remain in good standing throughout the year and also keep track of all of these expenditures so you can take full advantage of your deductions and your write-offs when tax time comes around. Additional write-offs include legal and accounting fees, travel expenses, property management and marketing costs, and also speaking with a small business consultant like myself. So keep in mind, again, spending money in your business is an investment. And not only is an investment, it's a potential write-off for next year's taxes. Never shy away from investing in your business. Never shy away from spending the necessary money to ensure that you're securing your profits in the future.